In When Genius Failed, financial journalist Roger Lowenstein explores the spectacular rise and catastrophic 1998 collapse of the hedge fund long-term capital management, LTCM. Lowenstein explores how LTCM, initially hailed as a financial genius, used complex mathematical models and sophisticated trading strategies to generate massive profits. The fund's founders and managers believed that they'd discovered a way to eliminate or at least greatly minimize market risk through their strategies. Their overconfidence in their models ultimately led them to make highly leveraged, i.e., debt-financed, bets on various financial instruments. The fund engaged in a variety of strategies involving arbitrage, taking advantage of price differences for the same asset or security in different markets to make a profit with little to no risk, interest rate swaps, and other derivative instruments to exploit supposed market mispricings. However, when the market was beset by volatility following the Asian financial crisis of 1997, LTCM's positions rapidly deteriorated, leading to the fund's demise and an orchestrated bailout by the Federal Reserve. In this guide, we'll explore the history of LTCM, how its models operated, how it achieved dizzying success, and how it crashed. Throughout the guide, we'll supplement Lowenstein's account with commentary from other financial experts and analysts, including commentators who wrote after the book's initial publication in 2000, adding insights to the LTCM story in light of subsequent events. Critical reaction to When Genius Failed. Upon its publication in 2000, When Genius Failed received critical acclaim for its detailed and gripping account of the rise and fall of long-term capital management, LTCM. The critical consensus was largely positive, with reviewers praising the book's narrative style, depth of research, and lessons about the risks and consequences of financial speculation. The New York Times highlighted the book's accessibility and ability to break down complex financial concepts for general readers. The review praised Lowenstein for turning a potentially dry financial story into a compelling human drama. Similarly, the Wall Street Journal commended When Genius Failed for its thorough research and well-constructed narrative. The review recognized the book's value in explaining complex financial concepts and the warning it offers about the dangers of over-leveraging and unchecked risk-taking in the world of finance. Finally, Forbes appreciated the book's attention to detail and the meticulous research that went into its creation. The review found it to be an excellent examination of LTCM's implosion and the broader implications for the financial industry. Part 1. The Rise of John Merryweather and the Birth of Quantitative Trading. Lowenstein writes that hedge fund manager and arbitrage expert John Merryweather was pivotal in the conception and formation of LTCM. In this section, we'll look at Merryweather's early career as a trader at Merrill Lynch, where he discovered the power of arbitrage strategies and convergence theory, and his formation of the arbitrage group at the investment firm Salomon Brothers. These activities set the stage for what he'd later do to great effect at LTCM. The power of arbitrage. Lowenstein writes that, at Salomon Brothers, Merryweather began his journey by learning the intricate art of arbitrage, a strategy that would become the linchpin of his success. Merryweather's arbitrage strategy at Salomon Brothers enabled him to exploit price discrepancies, turning them into substantial profits. At its core, notes Lowenstein, Merryweather's strategy was rooted in the concept of convergence. He believed that differences in price between nearly identical financial securities would eventually equalize. By structuring his trades to bet on these convergences, he consistently emerged richer at Salomon Brothers, far more often than he faced losses. Pure arbitrage versus relative value. Most arbitrage strategies can be split into two categories: pure arbitrage and relative value. Pure arbitrage involves capitalizing on observable price inefficiencies of identical products and is therefore considered riskless. For instance, imagine product X is currently priced at $50, while a futures contract, an agreement to sell the product at a fixed price later, for product X, expiring in 6 months, is valued at $55. In this simple example, by buying product X and selling the futures contract, one could lock in a $5 gain without taking any risk. This profit occurs because, over time, the prices of the actual product and the futures contract are expected to converge or come closer together due to market forces. Therefore, the arbitrageur can profit from the price difference when the two prices ultimately meet or converge. In contrast, what Merryweather was doing at Salomon Brothers, and later at LTCM, was a relative value strategy. Like pure arbitrage, relative value strategies aim to profit from price differences. However, relative value strategies do carry some risk. For example, in a pairs trading strategy, you select two closely related stocks from the same sector, such as Company X and Company Y, buying shares of Company X while simultaneously shorting, betting against, an equivalent value of Company Y's shares. If Company X's stock rises relative to Company Y's, you profit. If the inverse occurs, you incur losses. Because the two stocks can fluctuate independently, this strategy carries inherent risk, distinguishing it from pure arbitrage. Example: arbitrage strategy across two stock exchanges. Since it's such a key concept to understanding the book, let's take some time to illustrate arbitrage with an example. Suppose Company A is listed on both the New York Stock Exchange, NYSE, and the London Stock Exchange, LSE. On the NYSE, Company A's stock is trading at $100 per share. On the LSE, Company A's stock is trading at £80 per share. Assume the exchange rate between the US dollar, USD, and the British pound, GBP, is $1 equals 75 pence. Given this exchange rate, Company A's stock should theoretically be trading at approximately £133.33 on the LSE to be equivalent to its $100 price on the NYSE. Instead, an arbitrage opportunity exists because it's underpriced on the LSE. To execute the arbitrage trade, a trader buys Company A's stock on the LSE for £80. She simultaneously sells an equivalent number of Company A's shares on the NYSE for $100 each. So she buys 1,000 shares on the LSE for £80,000, 1,000 shares x £80 per share. At the same time, she sells 1,000 shares on the NYSE for $100,000, 1,000 shares x $100 per share. Over time, the prices of the same asset on different exchanges will tend to converge due to arbitrageurs like the hypothetical trader taking advantage of the price difference. The price will rise on the LSE from their buying activity and fall on the NYSE from their selling activity. As the prices on both exchanges converge, the arbitrage trader profits from the price difference. Suppose the price per share eventually converges to $90 on the NYSE and £90 on the LSE. She sells the 1,000 shares on the LSE for £90,000, 1,000 shares x £90 per share, and buys back the 1,000 shares on the NYSE for $90,000, 1,000 shares x $90 per share. After the prices have converged, she's made a profit because she initially bought on the LSE for a lower price and sold on the NYSE for a higher price. In this example, she has earned a profit of $10,000, the difference between her initial $100,000 sale on the NYSE and her $90,000 repurchase. Pioneering the arbitrage group at Salomon Brothers. By the early 1980s, writes Lowenstein, Merryweather had assembled a team of academic quants, individuals from academia who could introduce intellectual rigor and computer-based mathematical modeling into trading, moving away from the instinct-driven approach. His team at Salomon Brothers built computer models that identified market inefficiencies. They could pinpoint instances where bond prices deviated from what they should be in a perfectly rational market. These discrepancies presented unprecedented opportunities to buy below market value or sell above market value. The rise of computers. Merryweather's work in the 1970s and 1980s coincided with an era of exponential growth in computer processing power. The principle behind this growth is known as Moore's Law, which states that the speed and capabilities of computer chips double every 2 years due to chipmakers' increasing ability to fit more transistors on semiconductor chips. Since its promulgation in 1965, Moore's Law has largely held true. Merryweather's team successfully rode the computer processing wave as they were getting the arbitrage group at Salomon Brothers off the ground, with computing power increasing 1 trillion-fold from 1956 to 2015. It wasn't just the finance industry that computing power was revolutionizing. One study of labor and residential data from 1970 to 2000 shows a significant shift in the skills required for new jobs across all industries after 1980, with this shift beginning at the same time that the personal computer became ubiquitous. Computer-related jobs became the most in demand, and computer-related industries saw the fastest labor growth. By 2000, all the fastest-growing jobs were related to computers. The efficient market hypothesis. Lowenstein notes that the intellectual foundation of this computational strategy was the efficient market hypothesis, EMH, which posited that prices of stocks and bonds in the market were always rational. This implied that securities were always correctly priced, and the market would quickly correct any mispriced assets. The belief was that irrationality couldn't persist, but that temporary irrationality in pricing could be lucrative for the traders who knew how to spot it. The group consistently delivered impressive results. However, in 1991, the tide turned for Merryweather. A scandal involving a trader in his group rocked Salomon Brothers, ultimately forcing him out of the firm. While evidence of personal wrongdoing on his part was thin, his departure marked the end of an era at Salomon Brothers. Short-form note. Although Lowenstein writes that there was little evidence of Merryweather's personal culpability, reporting at the time painted a more nuanced picture of his role in this scandal. The New York Times reported that Merryweather was aware of a scheme within the company to manipulate the U.S. Treasury bond market in violation of the rules governing the auction process. The article suggested that Merryweather's knowledge of this scheme did implicate him in the wrongdoing. This raised questions about his level of responsibility and the potential complicity of top executives within the company, which was a significant factor in the scandal's notoriety and the subsequent investigations by regulatory authorities. The limitations of EMH. The limitations of EMH became apparent during the 2008 financial crisis. As Lowenstein writes, EMH posits that financial markets are efficient, with prices instantly reflecting all available information, making it impossible for investors to consistently outperform the market. However, the 2008 crisis was precipitated by the proliferation of risky practices such as subprime mortgage lending and the creation of complex derivatives. These practices were based on assumptions that didn't adequately account for market risks. Even though information about these practices was widely available, markets failed to efficiently respond. For instance, the housing bubble continued to inflate despite mounting evidence of its instability. Moreover, the credit rating agencies assigned top ratings to financial instruments that were inherently risky, thereby misleading investors. EMH would suggest that such practices should be instantly reflected in asset prices, but they weren't. Part 2. The birth of LTCM. Shortly after Merryweather left Salomon Brothers, he sought to create a new fund. In this section, we delve into the emergence of long-term capital management, LTCM, LTCM's unique convergence strategy, and the high-risk, high-reward nature of its approach. Merryweather's vision, long-term capital management, LTCM. Lowenstein writes that John Merryweather envisioned striking out on his own by applying the convergence strategy that had brought him success at Salomon Brothers. This marked the intellectual underpinning of what became LTCM. The core strategy was simple: buy assets identified as underpriced by their model while simultaneously shorting similar assets deemed overpriced. The premise was that the prices of these assets would eventually converge. In essence, LTCM aimed to buy low and sell high, at the same time they were selling high and buying low. The role of black swans in finance. While convergence strategy may sound appealing in theory, Merryweather and his team may have overlooked its practical complexities and risks. As Lowenstein writes, the strategy relies on the concept that mispriced assets will inevitably correct themselves, leading to convergence. However, this strategy doesn't account for black swan events, unpredictable and severe market disruptions. When these events occur, they can defy any expectations of convergence and lead to massive losses. Indeed, in A Random Walk Down Wall Street, Burton Malkiel writes that no matter how well-founded an investor's determination of an asset's value is, she can't account for randomness, such as the appearance of a groundbreaking technology, a new legal regime, or a surprise event like a public health or environmental emergency. Malkiel writes that financial history is littered with sure things, derailed by such randomness. Example: shorting stock. It's worth exploring in a bit more depth what a shorting strategy is and how it plays into the overarching convergence strategy. Shorting an asset is a way of placing a bet against it. If you believe, for example, that General Electric is about to sustain major losses, you can borrow shares of GE stock through your brokerage, with the promise to return those shares at an agreed-upon date. If the stock declines in value between when you borrow it and when you must return it, you earn a net profit on the transaction. If you borrow 10 shares of GE when it's selling for $100 per share and then immediately sell those shares, you pocket $1,000. If they're selling for $50 each when you need to purchase them in order to fulfill the contract, your net profit is $500. $1,000 minus the $500 you now need to spend to purchase the stock. But if the stock has risen in value between when you borrowed the shares and when you must return them, you suffer a net loss on the transaction. If GE is trading at $150 per share when you have to return the stock, your net loss is $500. $1,000 minus the $1,500 you now need to spend to purchase the stock at its higher price. Launching the fund. To start his new fund, notes Lowenstein, Merryweather recruited a team of top-notch academic economists and central bankers, including Robert Merton, Myron Scholes, who would later win a Nobel Prize in Economic Sciences, and David Mullins. Armed with his dream team, Merryweather and his fundraisers embarked on a roadshow, dazzling investors and successfully raising $1.25 billion in capital. They secured investments from European and Japanese banks, prominent American CEOs, and elite private universities. Lowenstein writes that many of these key investors were wowed by the intellectual brilliance of the LTCM partners and the track record they had at other firms. Investors saw LTCM as low risk since it was run by a team of ex-Salomon Brothers traders who had reached the pinnacle of financial success there, and they assumed the team could replicate that success. Crucially, however, notes Lowenstein, most of these investors had little understanding of how LTCM's complex trading strategy actually worked. They put their faith in the all-star partners roster and their sterling reputations. With funding in place, long-term capital management commenced trading in February 1994, marking the start of an ambitious venture that would have a significant impact on the financial world. Theranos, LTCM, and the failure of due diligence. Lowenstein writes that LTCM investors put their faith in the background and reputation of the LTCM partners, despite having little understanding of the firm's trading strategy. In effect, they trusted in the words and biography of the partners rather than performing due diligence about the soundness of the fund's business operations. But LTCM wasn't the last case of a supposedly groundbreaking company dazzling investors with promises of astronomical returns, and convincing those investors to forego due diligence. In Bad Blood, journalist John Carreiro writes that medical startup Theranos, whose blood testing technology was later revealed to be a fraud perpetrated by founder Elizabeth Holmes, lured investors and partners like Walgreens, taking advantage of that company's short-sightedness. As Carreiro writes, Walgreens couldn't pull out of Theranos once it had already committed to its investment, despite mounting concerns about the startup. As with the investors that Merryweather brought into LTCM, Theranos investors like Walgreens failed to perform due diligence. Walgreens' concern was that if Theranos innovation had turned out to be real, Walgreens couldn't risk competitor CVS taking it. Furthermore, in a classic sunk cost fallacy, Walgreens had already shouldered the money of building out new clinics with Theranos technology, and once it got deep enough, pulling out would have been intensely embarrassing. Another Theranos strategy was to land big-name investors, like former Secretaries of State George Shultz and Henry Kissinger, retired U.S. Marine Corps General and future Secretary of Defense, James Mattis, and former U.S. Senator Sam Nunn. By reeling in these big fish, the company was able to boost its reputation and lure in overly enthusiastic investors who failed to investigate the validity and viability of the company's technology. Leverage. Amplifying the strategy. Lowenstein writes that what set LTCM's approach apart was its use of substantial leverage, i.e., borrowed funds, to increase its volume of trades. Since price differences between the bonds they traded were marginal, the profits per trade were minimal. To generate substantial profits, LTCM needed to execute trades at high frequencies and volumes, which required a significant reserve of capital. And they could only acquire those reserves through borrowing. The strategy was an inherently high-risk, high-reward one for LTCM. If their model succeeded, profits could be magnified manifold times through leverage. However, if the model failed, losses would also be greatly amplified due to the debt incurred. Short-form note: LTCM's high use of borrowed funds touches on an important concept in finance known as leverage ratio. A leverage ratio is a critical financial metric used to assess the capital adequacy and risk exposure of financial institutions, such as banks and investment firms like LTCM. The leverage ratio is calculated by dividing the institution's Tier 1 capital by its average total consolidated assets. Tier 1 capital is the core capital of the institution and includes common equity and retained earnings. Typically, regulatory authorities set minimum leverage ratio requirements for financial institutions. These requirements are in place to ensure that institutions maintain a minimum level of capital relative to their total assets. However, banks were willing to provide loans generously due to the perceived prestige of LTCM. Despite LTCM's lack of transparency and secretive internal culture, the banks competed for the opportunity to lend to LTCM, seeing the new hedge fund as a potentially valuable client. Accordingly, the banks were willing to lend on highly favorable terms, even if they had a difficult time understanding exactly what LTCM was doing. Information asymmetry leads to poor decisions. The bank's failure to understand LTCM's business model, despite investing heavily in it, demonstrates the point that people often make decisions with flawed or incomplete information. In Freakonomics, authors Stephen J. Dubner and Stephen Levitt write about the phenomenon of information asymmetry, situations where information is unequally distributed between parties. Dubner and Levitt warn that experts can skillfully exploit information asymmetry when they leverage their superior knowledge to gain the upper hand over their counterpart in a transaction or negotiation. Information asymmetry can have a system-wide impact, with the 2008 financial crisis as a prime example. In the run-up to the crisis, Wall Street financiers created products like derivatives, financial instruments whose value derives from an underlying asset, and collateralized debt obligations, complex financial products that bundle various debt assets, such as mortgages or bonds, into one security, whose larger implications many investors simply didn't understand. When the housing market collapsed, those investors who bought these products were wiped out, while the sellers, who possessed a major information advantage, made a tidy profit. Part 3. LTCM's stunning initial success. With the foundation thus laid, it was time for LTCM to put its strategy into action. In this section, we'll explore the extraordinary rise of LTCM and the growing risks posed by its high leverage, which ultimately set the stage for its downfall. Implementing the strategy. Lowenstein writes that LTCM boasted an astounding 28% return in its first year of operation in 1994, significantly outperforming the broader market. Their approach was grounded in quantitative and mathematical methods, giving an impression of rationality and scientific precision. LTCM's success was predicated on its ability to find arbitrage opportunities and capitalize on mispricing across various financial assets, from mortgage-backed securities to international bonds. Fundamental versus technical analysis. LTCM's approach of eschewing analysis of individual companies and stocks and instead looking at large data sets from a quantitative perspective speaks to the differences between two schools of investing thought: fundamental analysis and technical analysis. Fundamental analysis is the more traditional approach, which attempts to measure the intrinsic value of a stock. Adherents of this philosophy seek to answer why a particular stock goes up or down in value. They do this, as the name suggests, by delving into the fundamentals of the company behind the stock. They'll look at sector-wide trends and the company's earnings, expenses, assets, and liabilities to make predictions about what the stock will do. Technical analysis, on the other hand, identifies trends and correlations, how a particular stock goes up or down in value. It's much closer to what LTCM was doing. Technical analysts assume that the fundamentals are already factored into the stock price, so it's a waste of time and effort to analyze them. Instead, they use mathematical analysis to identify patterns and trends within the market and across different types of financial instruments, like stocks, bonds, commodities, and currencies. These trends can then signal what a stock will do in the future and if its current pricing is rational or not. A mistaken assumption of predictability. According to Lowenstein, LTCM's model was built on the assumption that financial markets behave predictably. The crux of the problem, writes Lowenstein, lay in that core assumption of the world's rationality and predictability. In reality, the real world is complex, shaped by irrational human behavior, and events are often influenced by panic and fear, making human actions less predictable. Lowenstein writes that research by Eugene Fama highlighted the higher risk of extreme or tail events in markets, contrary to LTCM's belief in constant predictability. Markets, in fact, exhibited more extreme price movements than would be expected from a normal distribution curve. The likelihood of an extreme financial event, say, a sudden, across-the-board collapse in asset prices, was far more likely than their models predicted. In a few short years, such outlier events would prove fatal to LTCM. The shortcomings of the Homo economicus model. LTCM's operating theory about the fundamental rationality of economic actors is a well-established intellectual foundation of economics. In Donut Economics, economist Kate Raworth calls this the Homo economicus model, which asserts that human beings are essentially rational, utility-maximizing entities, able to process, calculate, and have perfect access to information to make the optimal choice for themselves in all situations. It is a portrait of humankind rooted in self-interest, unconcerned with deeper moral imperatives like charity or altruism. Rational economic man cares only about increasing his material wealth and will always follow incentives to do so. According to Raworth, the Homo economicus model is a gross and inaccurate caricature of the nuances and complexities of the human condition. Rather than pure utility maximizers, we are highly social beings who prize intangibles like the respect, love, and admiration of our peers. Indeed, our lives abound with examples of reciprocity and altruism with no clear material benefit. For instance, imagine a group of friends is planning to buy a gift for one of their friends who's going through a tough time. According to the Homo economicus model, each friend should contribute the minimum amount possible to the gift to maximize their own economic utility. However, in reality, the friends might choose to contribute more than the minimum required, driven by their desire to show support and express their love for their friend, even if there's no immediate material benefit for them. This behavior exemplifies how humans often prioritize social and emotional connections over pure economic self-interest. Continued profits and growth. Despite these philosophical flaws, writes Lowenstein, LTCM continued to amass impressive profits, earning 59% or $1.6 billion in 1995. Wall Street bankers were eager to lend more money to the fund, given its outstanding performance. LTCM had become the darling of Wall Street, outgrowing even the largest mutual funds. By 1996, the partners had collectively earned 9 times their initial investment, a staggering return on investment. In that year alone, LTCM's profits exceeded $2 billion, surpassing those of major Fortune 500 companies and even Wall Street giants like Merryweather's old firm, Salomon Brothers. However, its rapid growth was precarious. For every $1 in assets, the fund had $28 in debts. LTCM kept banks in the dark about the fund's total degree of leverage, and they refused to disclose the assets on their balance sheet. Banks had to rely on LTCM's supposed genius and financial acumen, which masked the true riskiness of the investments they were unknowingly bankrolling. Short-form note: Lowenstein's account that banks had little idea about the assets on LTCM's balance sheet, and the fact that they, as LTCM investors, were also invested in those assets, can be seen as a harbinger of the system-wide calamity that befell the global financial system a mere decade after LTCM. Michael Lewis writes in The Big Short that major banks like Bear Stearns and HSBC had exposure to the collapsing subprime mortgage market. But because of the complexity of these bonds, very few people inside or outside these firms could tell exactly how much exposure they had to subprime mortgages. No one knew for sure how many of these toxic assets were littered across the balance sheets of the world's leading financial institutions. Part 4. The Fall of LTCM. The year 1997 was the beginning of the end for LTCM, as it succumbed to the enormous risks it had taken on and the combined pressures of the 1997 Asian financial crisis and the 1998 Russian financial crisis. In this section, we'll explore how unexpected volatility began to sink the fund. 1997. The Asian financial crisis begins. In 1997, the currencies of several Asian countries, Indonesia, Malaysia, the Philippines, South Korea, and Thailand, the so-called Asian tigers, collapsed. In the years leading up to the crisis, investors had mistakenly believed that the economies of these nations were on sounder footing than they actually were. As a result, when these currencies collapsed, those investors found that their money was now tied up with these sharply devalued currencies. The crisis spread to the U.S. as the American stock market suffered a 7% decline in a brutal sell-off on October 27, 1997. The crisis threatened to undermine LTCM's whole strategy. In a turbulent market, asset prices tend to fall together. There aren't price discrepancies, writes Lowenstein, because everything collapses at the same time. There wouldn't be arbitrage opportunities to exploit. There would instead be a liquidity crisis where everyone was trying to sell their much-discounted assets at the same time, LTCM included. This had the potential to wipe out the fund. Short-form note. Experts suggest that during a liquidity crisis, businesses can take some key steps to protect themselves. The steps include understanding their current cash position, cash flows, and the impact of the crisis on their operations. Companies should focus on managing cash flows, which may involve accelerating cash collections, delaying payments, and closely monitoring working capital. Businesses should develop various financial scenarios to understand the potential impacts of the crisis on their liquidity. This helps in making informed decisions and contingency planning. Finally, companies should explore all available sources of capital, including bank credit lines, government relief programs, and negotiations with lenders and investors. Currency pegs, overvaluation, and the 1997 Asian financial crisis. To give a more complete understanding of the circumstances that led to LTCM's collapse, it's worth adding some historical context for the 1997 Asian financial crisis. The crisis was triggered by the fixed exchange rate regimes, or currency pegs. By pegging their currency to a stronger foreign currency, like the US dollar, developing countries, like the Asian countries affected by the crisis, often hope to instill confidence in foreign investors and facilitate trade. By pegging their currency to a stronger one, these countries aim to provide stability and predictability for businesses and investors, making it more attractive for foreign capital to flow into their economies. However, when currencies are pegged to stronger ones, they can become overvalued, meaning their exchange rate doesn't accurately reflect economic fundamentals. This is what happened in 1997. Due to the overvalued currencies, many businesses in these Asian countries borrowed in US dollars at low interest rates. However, when their local currencies devalued, the real cost of servicing this debt in foreign currency soared, causing financial distress and corporate bankruptcies. As the crisis deepened, several Asian countries were forced to abandon their currency pegs and allow their currencies to devalue. While this helped restore export competitiveness, it significantly impacted foreign investors who had assumed the exchange rate was stable and suffered losses when the local currencies devalued. The Russian collapse and the flight to treasuries. The collapse of the Russian ruble in August and September 1998 exacerbated the impending liquidity crisis in global financial markets, intensifying the fund's difficulties. Russia defaulted on its financial obligations, sending shockwaves throughout global financial markets. This triggered widespread panic as investors sought refuge in U.S. Treasury securities. Short-form note. Despite the calamity, some financial historians have written that the 1998 Russian crisis taught some valuable lessons. First, it demonstrated the interconnectedness of financial markets and how the default of even a relatively small emerging market like Russia could have a ripple effect on global markets. Secondly, It underscored the unique risks of investing in emerging markets and the need to evaluate political and economic stability, regulatory environments, and currency risks in emerging market investments. Finally, the Russian crisis showcased the importance of robust risk management strategies, diversification of portfolios, and the need to account for possible sharp market fluctuations. For LTCM, this situation led to a noticeable difference in prices between U.S. Treasury bonds and other financial products. This difference influenced a broad array of assets, including common ones like stocks and foreign bonds, as well as more complicated financial tools like options, derivatives, and swaps. People rushed to invest in treasuries, which are seen as safe because they're backed by the U.S. federal government. This surge in demand caused the prices of treasuries to go up while the prices of everything else went down. Does U.S. political dysfunction threaten the security of treasuries? Lowenstein writes that investors flocked to U.S. Treasury bills, notes, and bonds because of their perceived safety. In The Deficit Myth, economist Stephanie Kelton notes that American national debt is created through the sale of these bonds. Because the federal government can never default on these bonds, because it has monetary sovereignty that enables it to always create the dollars it needs to make the interest payments, they are considered risk-free securities. However, some have argued that the growing political dysfunction of the United States could jeopardize that status. The U.S. federal government has a statutory limit on how much it is allowed to borrow to meet existing financial obligations, the debt ceiling. When the Treasury Department informs the President that the government is approaching this limit, Congress is supposed to pass new legislation that raises this figure and allows the government to pay its creditors. To not raise the debt ceiling, therefore, is to force the United States to default on its debt, even though, as Kelton argues, the U.S. has unlimited power to create the dollars it needs to meet its debt obligations. Unfortunately, the debt ceiling has become a political football in recent years, with congressional Republicans threatening to withhold the votes to raise the debt ceiling to force spending cuts and other policy concessions from Democratic presidents, as happened in 2011 under Barack Obama and again in 2023 under President Joe Biden. Analysts warn that these brinksmanship exercises hurt confidence in the U.S. dollar and U.S. Treasury debt as safe assets, and could cause them to cede some reserve status to other currencies like the euro. On the wrong side of the trades. Compounding LTCM's woes was the fact that their existing positions were based on the expectation of the opposite scenario. Their entire strategy was built on the belief that markets overstated risk and that the price differences between risky assets and safe assets would eventually converge. Consequently, they often held the riskiest and most volatile assets in various markets. When universal panic gripped the market in 1998 following the Russian crisis, nobody had any interest in purchasing LTCM's holdings, and everyone was eager to rid themselves of these toxic assets. LTCM found itself in a dire predicament, with seemingly no way out. With the value of their assets now reduced to a fraction of their former worth, their debts constituted an even larger portion of their balance sheet. By September, LTCM was operating with a highly leveraged position of $55 in leverage for every $1 in assets, and the fund was hemorrhaging 8 figures per day. Short-form note. For a true sense of the scale of LTCM's leverage, financial experts write that a debt ratio, total debt divided by total assets, of greater than 100% is often considered risky for investors. But LTCM had a debt ratio of 5,500%, vastly greater than what most analysts would consider safe. However, it's worth noting that the debt ratio, while useful for assessing a company's financial standing, doesn't provide information about the type of debt or its associated costs. Different debts may have varying terms and interest rates, impacting a company's financial stability differently. Additionally, the debt ratio relies on accounting information that can be manipulated for external reporting. The panic market trumps the rational market. Lowenstein writes that the market was characterized by panic, representing a state of irrationality. Human emotions, including greed and fear, were driving economic decisions, highlighting the flawed and irrational nature of such decisions. The market deviated from a normal distribution pattern. LTCM's quantitative models were incapable of accounting for this irrationality, as they were built upon a framework assuming rational and utility-maximizing decisions. Short-form note. Some economists have written that economic models need to be updated to consider the influence of human psychology on economic decision-making. Behavioral economics recognizes that individuals don't always make rational choices and can be influenced by cognitive biases, emotions, and social factors. Furthermore, there is a push to incorporate the principles of complex system dynamics into economic modeling. Complex systems theory acknowledges that economic systems are interconnected and subject to feedback loops, making them inherently unpredictable and susceptible to sudden shifts and crises. An orchestrated bailout. As the house of cards that was LTCM collapsed, the New York Federal Reserve Bank stepped in to orchestrate a bailout. According to Lowenstein, the Fed played a pivotal role in assembling a consortium of Wall Street banks to stabilize and wind down the troubled LTCM. The final terms of the rescue package involved a consortium of over a dozen major banks collectively contributing more than $3.5 billion and acquiring 90% of whatever value remained in the fund. In a stark transformation, the original partners retained only a 10% stake as an incentive for their assistance in winding down the fund and ensuring creditors were made whole. The partners found themselves effectively wiped out, and the banks were left to recoup whatever assets remained. The impact extended beyond the fund. It significantly affected the partners themselves, many of whom had substantial personal wealth tied up in the fund. The collapse pushed several of them into personal bankruptcy. John Merryweather's post-LTCM career. Although Merryweather avoided personal bankruptcy following LTCM's collapse, his later career would be marked by unsuccessful fund ventures. Just a year after the demise of LTCM, Merryweather founded another company, JWM Partners. Its flagship fund, Relative Value Opportunity II, reached a net asset value of about $1.6 billion at its peak but declined by more than 44% following the 2007 financial crisis. Perhaps unchastened by his experience at LTCM, the poor performance of Merryweather's fund was exacerbated by its continued use of high leverage, with reports of up to 10 and 15 times leverage, a substantial amount of risk considering most hedge funds reduced their leverage to as little as 2 times or less after market volatility in 2007. The fund finally closed its doors in 2009, after suffering staggering 44% losses from 2007 to 2009. A tale of hubris. Lowenstein writes that the LTCM episode served as a stark reminder that even the brightest minds in finance were not immune to failure. In a period of soaring returns on Wall Street during the 1990s, LTCM's renowned academics and financial wizards were among the few who managed to lose money. By the end of the crisis, the fund's assets were worth a mere 23% of their peak value. The bailout of LTCM raised legitimate concerns about moral hazard, as it prompted questions about whether rescuing reckless speculators only encouraged future speculative behavior. It also led to a broader debate about whether preventive regulation to avert a financial crisis might be a superior approach to the post-crisis bailouts. Overstating the risk of moral hazard. Some critics have argued that the concept of moral hazard, often cited as a central issue in the financial industry, may be somewhat overrated. Moral hazard is the idea that people and institutions might take on excessive risks if they believe they won't bear the full consequences of those risks. In the context of the 2008 financial crisis, it was a common belief that financial institutions might engage in reckless behavior because they anticipated government bailouts in the event of a crisis. However, some contend that this traditional view of moral hazard is somewhat simplistic. It asserts that financial institutions, particularly after experiencing the full-blown impact of the crisis, were far more cautious and risk-averse than expected. They were aware that government bailouts could have severe consequences and didn't want to rely on them. In the wake of the crisis, many financial institutions were either severely weakened or completely collapsed, further illustrating that their perceived safety nets might not be as reliable as previously assumed. Moreover, according to this argument, the conventional understanding of moral hazard fails to account for the complexity and nuances in the financial industry. Financial institutions are subject to various regulatory and market pressures, and they operate in a dynamic and interconnected environment. This means they often have incentives to minimize risks rather than exploit perceived safety nets.